Picture this. It's a beautiful Monday morning. You reach for your iPhone, open your banking app to pay for your morning latte, and you aren't greeted by your usual balance. You're greeted by a gray error screen, or worse, a big fat zero. Not because you spent it all, but because the institution holding your money just evaporated. Sounds like a doomsday script or a Black Mirror episode, right? Wrong. This is the exact flavor of fear that millions of Americans tasted on that fateful day, September 15, 2008, when Lehman Brothers, a 158-year-old titan, a firm deemed too big to fail, collapsed like a house of cards in a hurricane. I'm not here to bore you with textbook history. I'm here to tell you why Ben Bernanke, Douglas Diamond, and Philip Dybvig took home the Nobel Prize in Economics in 2022. They didn't win it for finding a way to get you rich quick. They won it because they decoded the doomsday machine sitting right in your pocket. They looked the financial monster in the eye and told us the ugly truth. The banking system isn't the steel vault you think it is. It's a ticking bomb designed with terrifying precision. Let's rewind to 2008. If you've seen The Big Short, you remember Ryan Gosling pulling blocks from a Jenga tower to explain mortgage bonds. But the reality on the street was far more brutal. When Lehman Brothers filed for bankruptcy, it wasn't about guys in $5,000 suits on Wall Street losing their jobs. It was panic spreading like a virus. Credit markets froze. Companies like General Electric, icons of American industry, suddenly couldn't borrow money to make payroll overnight. The blood flow of the global economy stopped. And that's when everyone woke up to the naked truth that Diamond and Dybvig had warned about since the 80s. Bank stability is just a psychological illusion.
Have you ever asked yourself why banks even exist? Why not just stuff cash under your mattress? Diamond and Dybvig pointed out that banks do something no individual can do: maturity transformation. Sounds academic, but in street terms, the bank takes the cash you deposit, which you can withdraw anytime, and lends it to a startup guy in Silicon Valley for 10 years, or to a couple in Florida to buy a house for 30 years. Your money is short-term, but the bank's investment is long-term. And this is where it gets interesting and dangerous. This model runs smooth as silk as long as everyone is happy and trusting. But all it takes is a rumor, a spark of fear, like when Peter Thiel yelled, "Get your money out," during the recent Silicon Valley bank debacle, and the herd will trample each other rushing for the exit. And because your money is stuck in that Florida house or that tech startup, the bank doesn't have the cash to pay everyone at once. Boom! That's a bank run. In the classic film It's a Wonderful Life, George Bailey begged people not to withdraw their cash all at once. But real life isn't a movie. In the real world, nobody listens. When panic hits, it's the law of the jungle. The slow buffalo drinks muddy water, the latecomer loses everything. But the 22 Nobel story isn't just about panic theory. It stars Ben Bernanke, the man who sat on the hottest seat in the world, chairman of the Federal Reserve during the 2008 crash. Before he became Mr. Money Printer and was vilified by half of America, Bernanke was a nerdy academic obsessed with the Great Depression of 1929. Think back to 1929. Most economists back then thought bank failures were the result of a bad economy, like economy sad, people broke, banks die. The end. But Bernanke, with thick glasses and a detective mind, reopened the cold case. He proved the exact opposite. The collapse of the banking system was the cause that turned a normal recession into a decade-long Great Depression. When banks died, information dies. Credit relationships, knowledge of borrowers, trust, all that social capital vanishes. Nobody dares to lend to anyone, and the economy is strangled to death.
Bernanke's research wasn't just ivory tower theory. When 2008 hit, he used the very map he drew in the 80s to navigate the US ship through the storm. He knew that if he let giants like AIG or Citigroup fall like dominoes as they did in 1929, we'd be back in the economic Stone Age. So he did the unthinkable. He injected money, tons of it. TARP, quantitative easing, QE, terms that drive conservatives crazy, were essentially massive shots of adrenaline injected straight into the chest of a dying patient. So why does this Nobel matter to you, a global citizen scrolling through the internet in the 21st century? Because the trio of Bernanke, Diamond, and Dybvig exposed the naked infrastructure of modern capitalism. They showed us that our prosperity is built on a thin layer of ice called trust and liquidity. Once you understand this mechanism, you won't look at headlines about Fed rates, the collapse of Credit Suisse, or the slow-motion train wreck of Chinese real estate with innocent eyes anymore. You'll see the gears grinding, and you'll know when to hold onto your wallet tight. But wait, theory is cool, but how exactly does this machine operate in the real world? Why can a bank with billions in assets die because of a tweet? And how is information asymmetry the greatest pickpocket in history? We need to go deep into the engine, where the numbers dance and the lies are sugar-coated. Brace yourself. In the next part, I'm going to dissect exactly how this system plays us every day through examples you've definitely seen but never truly understood.
Welcome back. We just left the crime scene. Now let's roll up our sleeves and step into the engine room. Don't expect a clean, sterile environment. This engine of the financial system is covered in grease, noise, and rusting gears trying desperately to turn. In this section, I won't throw dry math formulas at you. Instead, we're going to dissect the mechanics of this Nobel Prize through disasters that the press calls accidents, but insiders call features. 1. The liquidity illusion, or why Silicon Valley Bank froze to death. To understand the Diamond-Dybvig model, you don't need a PhD. You just need to look at the still warm corpse of Silicon Valley Bank from March 2023. This is the perfect textbook example fresh off the press for what we call maturity mismatch risk. Picture this. SVB was the go-to bank for the tech crowd. Who were their clients? Roku, Circle, and thousands of startups burning cash faster than the Joker burning a mountain of money in the dark night. These guys parked their cash at SVB, but needed to withdraw it at any moment to pay developers. This is short-term liability. What did SVB do with that pile of cash? They didn't let it sit there. They acted like a safe money manager. They bought U.S. government bonds and mortgage-backed securities, MBS. Sounds safe, right? U.S. Treasuries are the safest asset on the planet. But here's the catch. They bought long-term bonds. This is long-term assets. Diamond and Dybvig pointed out the death trap here, the timing mismatch. When the Fed hiked interest rates to fight inflation, the value of those long-term bonds tanked. Basic rule, rates up, bond prices down. Technically, if SVB held the bonds to maturity, 10 to 30 years, they wouldn't lose a dime. But life doesn't let you wait 10 years. On that fateful day, Peter Thiel and his founders fund smelled smoke. They texted their portfolio companies, "Get out now." And just like that, the prisoner's dilemma that Diamond Dybvig described was activated. If everyone sits still, the bank lives. But if I think you are going to withdraw, I have to withdraw before you. And if you think I'm going to withdraw, you have to run faster than me. In the digital age, there are no lines of people down the block anymore. A $42 billion bank run happened via a few clicks on iPhones, while CEOs sipped lattes in Palo Alto. SVB didn't collapse because they were a fraud, like FTX. They collapsed because they were swallowed by the very mechanism of maturity transformation the moment trust evaporated.
2. Information asymmetry, when the gatekeeper becomes the accomplice. Now let's talk about Ben Bernanke's part and the concept of delegated monitoring. Why do you deposit money in JP Morgan Chase or Bank of America instead of lending it to your neighbor to open a pho noodle shop? Because you don't have the time or skills to check if your neighbor actually knows how to cook pho or if he's going to blow the cash on sports betting. Banks exist to do that for you. They are the professional appraisers. They have data, lawyers, and processes to filter out the bad actors. That's why they earn the interest spread. But what happens when this gatekeeper goes blind, or worse, willfully closes its eyes? Look at the 2008 crisis through the lens of The Big Short. In the movie, Mark Baum, based on the real Steve Eisman, goes on a field trip to Florida. He meets a stripper who owns 5 houses and a condo. She has no stable income, no savings, yet the bank threw loans at her. Why? This is the collapse of delegated monitoring. Banks like Washington Mutual or Countrywide Financial threw their responsibilities out the window. They lent recklessly, subprime mortgages, because they could package those bad debts, slap them with a grade A sticker, and sell them to naive investors. At this point, information asymmetry hit its peak. Bond buyers, pension funds, cities in Norway, or even you, thought they were buying gold, but they were buying toxic waste. Bernanke argued that when banks collapse, we lose more than just money. We lose information. When Lehman Brothers fell, millions of credit relationships were severed. Nobody knew who was trustworthy anymore. Banks were scared to lend to each other, scared to lend to businesses. The blood of credit coagulated. To visualize this, imagine your phone contacts are wiped, your message history is gone, and your LinkedIn is permanently locked. You are still you. Your skills are the same, but you can't do business anymore because your social capital and credit history have vanished. Bernanke proved that this sudden blindness of the financial system is what drags down the real economy, closing factories and firing workers, not just a dip in the stock market. The modern banking system is like a nuclear power plant. It provides massive energy to the economy,
turning idle cash into investment capital. But its reactor core, maturity transformation, and leverage is always in an unstable state. Diamond, Dybvig, and Bernanke didn't design this machine. They just drew the blueprints to warn us. If just one screw named trust comes loose, the whole plant blows up. And terrifyingly, the cracks are starting to appear not just in a few US banks, but globally, from abandoned skyscrapers in China to the cold calculations of the Kremlin. In the next part, we're going to zoom out to the world map. I'll show you the global glitch happening right now and why the theories of these three old professors are playing out in a chilling way across superpowers.
If you think what Diamond and Dybvig warned about only applies to regional banks in California or some sleepy town, you are dead wrong. Grave mistake. These theories explain the tremors shaking superpowers, the giants we once thought were invincible. Let's look across the hemisphere to the world's second largest economy, China. This is the most horrific macro example of mismatched maturity history has ever witnessed. But here, the bank doesn't hang a bank sign. It hangs a sign that says real estate developer. Let's talk about Evergrande. This conglomerate didn't just build houses. They operated exactly like a shadow bank. They took prepayments from millions of Chinese citizens for apartments that weren't built yet. That is a short-term liability. The trust that I give you money today, you give me a home tomorrow. But what did Evergrande do with that cash? They didn't just build that specific apartment. They speculated on land, invested in electric vehicles, even bought a soccer team. These are long-term assets that are incredibly illiquid. When Beijing tightened credit with the 3 red lines policy, the cash flow snapped. People panicked and demanded their homes, equivalent to demanding a withdrawal. But Evergrande couldn't pay in homes immediately because the money was stuck in vacant lots or unfinished concrete skeletons. This is a bank run straight out of the Diamond Dybvig model. But the scale is hundreds of billions of dollars, and the victims didn't just lose savings, they lost their shelter. A massive real estate market froze due to lack of liquidity, dragging down the entire Chinese economy, proving that when trust in the ability to repay collapses, even the Asian dragon stumbles. Next, fly over to Europe, a place that seems older and safer. Nope. Look at the corpse of Credit Suisse. This wasn't a scrappy startup, this was a symbol of Switzerland, born in 1856, the bank that helped build the nation's railways. Yet it collapsed in a single weekend in March 2023.
Why? Why did a financial institution with over 500 billion Swiss francs in assets have to sell itself to UBS for pennies? Here, Bernanke's theory on information and social capital plays a brutal role. Credit Suisse didn't die because it ran out of cash instantly. It died because it was involved in scandal after scandal, from corporate espionage to facilitating money laundering and the fatal double punch from the collapse of hedge funds, Archegos Capital, and Grinsell Capital. These events completely destroyed Credit Suisse's information capital. The global ultra-rich, the pickiest clients, looked at the bank and no longer saw a safe haven, they saw risk. In the digital era, rumors travel faster than light. Clients didn't line up outside the Zurich branch, they withdrew tens of billions of dollars a day via electronic transfers, an unstoppable digital bank run. The Swiss government was forced to intervene, breaking every free market rule to force UBS to buy Credit Suisse, because they understood Bernanke's lesson. If Credit Suisse totally collapsed, the credit veins of Europe would succumb to sepsis. Finally, let's talk about the weaponization of the banking system in the Russia-Ukraine conflict. When the West kicked Russia out of the SWIFT international payment system, they were conducting a massive economic experiment based on Bernanke's principles. SWIFT is essentially an information system. When you cut the connection of Russian banks to the world, you are destroying the credit information network. You turn Russian banks into isolated islands. Even if Russia has oil and gas, real assets, they lose the ability to transact efficiently, liquidity, and information. This forces Russia back to primitive trading methods or dependence on the Chinese yuan. It proves that in the modern world, money isn't just paper or numbers. Money is a network. Whoever controls the network, in this case the US and EU, controls the life and death of a rival economy. Bernanke showed that bank failures cause depressions because information breaks, and now the West is actively cutting the cables of that information to strangle a nuclear power.
Looking at this global glitch landscape, what do you realize? The world is flatter and more fragile than we thought. A sneeze in Silicon Valley can cause pneumonia for a startup in London. A decision in Beijing can shake steel prices in Brazil. And a sanction from Washington can redraw the map of global cash flow. The global financial system runs on a paradox. We need interconnection to grow, as Diamond Digvig described pooling short-term funds for long-term investment. But that very interconnection creates an unstoppable domino effect when trust collapses. No nation, no matter how strong, is immune to this law. So amidst the storm of these stumbling giants, where do you, a small individual, stand? Should you withdraw all your cash and stuff it in a jar buried in the backyard? Should you buy gold, Bitcoin, or just ignore it all? We've gone through history, theory, and geopolitics. Now is the most important part. Now it's time to talk about you. The final section won't be about Bernanke or billionaires anymore. It's the takeaway, street-smart lessons to protect your own wallet before the next tsunami hits. Take a deep breath, because the advice coming up might go against everything your bank teller sweetly whispers in your ear.
All right, cut the projector. We've heard enough about genius, Nobel brains, trillion-dollar figures, and epic collapses. Now it's time to sit down, look each other in the eye, and talk about the most important thing, the money in your pocket. You are not the Federal Reserve. You don't have a money printer in your basement to save yourself like Uncle Sam. You aren't the CEO of JP Morgan waiting for the government to catch you when you fall. You are a small pawn on this ruthless chessboard. So, how do you avoid becoming the next sacrificial lamb when the system glitches? Here is the survival rulebook based on what Bernanke, Diamond, and Dybvig warned, distilled into street style. Firstly, don't marry your bank. The biggest mistake startups in Silicon Valley made was laziness and naivety. They left tens, even hundreds of millions of dollars in a single place, Silicon Valley Bank, because it was for convenience and for relationships. Diamond and Dybvig taught us, banks are always technically in a state of risk because they use short-term money to fund long-term deals. The move? Diversify. Never put all your eggs in one basket. If you're in the US, the FDIC insurance limit is $250,000. If you have $500,000, split it into 2 banks. In other countries, know your deposit insurance limit's cold. Don't let blind loyalty kill your finances. When a collapse happens, your friendly bank won't send an apology card. They'll shut down the website. 2. Cash is king isn't just a slogan. In peacetime, Ray Dalio says cash is trash because inflation eats it. But Bernanke proved when a crisis hits, liquidity is oxygen. Why did Lehman Brothers die? Not because they were poor, but because they didn't have cash immediately. They died of thirst while sitting on a massive pile of assets they couldn't sell. Real estate, derivatives. Don't let yourself become a forced seller right when the market hits rock bottom.
3. Beware the high-yield trap. Bernanke spent a lifetime studying risk, the iron law of finance, high risk, high return, no exceptions. If a fintech app, a crypto exchange, like Celsius or FTX, or a corporate bond offers you 15 to 20% interest per year, while major banks only pay 5%, remember information asymmetry. They are hiding something from you. The move? Ask yourself, why do they need my money so badly that they're paying such high interest? Usually the answer is because legitimate banks refuse to lend to them because they are too risky. Don't get greedy picking up pennies in front of a steamroller. When a Ponzi scheme collapses, the yield chasers are the first to die because they are the last creditors, aka the bag holders. 4. Don't panic first, but don't be the last one out. The Diamond Digvig model is a game of psychology, game theory. If everyone stays calm, the system is safe. But if there is a rumor, it becomes a self-fulfilling prophecy. The move? Follow the news, but don't be a sheep. However, if you see real signs, bank stock prices free-falling, executives dumping their shares, or financial reports being delayed, move fast. Withdrawing money a little early is better than losing it all. In the SVB case, those who withdrew on Thursday morning survived. Those who waited until Friday afternoon got stuck. Ruthless? Yes, but that's the law of the Wall Street jungle. The 2022 Nobel Prize wasn't a medal honoring the perfection of the financial system. On the contrary, it was an admission by the academic world that this system is fundamentally buggy by design. We accept living with this risk because it helps the economy grow faster. But you, as a global citizen, you don't need to be its victim. View banks as utility tool, not an eternal safe. Be skeptical, be pragmatic, and always leave yourself a back door. As Tyrion Lannister said in Game of Thrones, a Lannister always pays his debts. But in the real world, banks aren't House Lannister. When they collapse, they won't pay you. The government might save the bank to save the economy, but shareholders and bondholders usually go home empty-handed. Stay sharp, keep a cool head, and hold your wallet tight.